Namaste and welcome to our 2022 panel event on super funds at a Crossroads, hosted by the Finance Department at the UTS Business School. My name is Lorenzo Casavecchia and I'm the Associate Head External Engagement of the Finance Department. On behalf of the UTS Business School, I would like to welcome our panelists and audience. We are delighted to have more than 350 registered attendees across Australia from government and regulatory agencies, super funds, investment consultants, and asset managers, and of course, university scholars. We are also broadcasting to attendees connecting from 9 other countries. Thank you all for joining us today, despite any time difference. Firstly, we would like to acknowledge that at the UTS Business School, we are on the land of the Gadigal people of the Eora Nation. Since the event is broadcast across Australia, we would also like to pay our respect to elders, past and present, across the country. Quick disclosure, we are recording the event for educational purposes, so by partaking in the event, you agree to the recording. As always with these webinars, we do encourage you to post your questions in the chat, and my colleague, Dr. Chris Glover, connecting there, will moderate the chat and pass your questions to our panelists at the end of the session, time permitting, of course. I have the pleasure today of moderating a panel of 4 distinguished speakers. Mark Burgess, Investment Community Chair at HESTA, David Carruthers, Head of Member Solutions at Frontier Advisors, David Bardsley, Partner Operations Advisory at KPMG, and Dr. Jack Ray, former CIO at Sun Super. As you probably noticed, there has been a slight change in our roster due to last-minute impediments. I'd like to welcome all the panelists and thank them for their time today. Since 2011, the Australian superannuation industry has experienced waves of large-scale mergers across all sectors of the industry. In the UK and the Netherlands, pension fund consolidation remains among the most significant trends. Other European countries are also experiencing and debating consolidation. In many cases, regulatory authorities have been driving this process, but individual pension funds have also seen the merit of creating larger organizations. For regulators, overseeing fewer and more resourceful organizations means easier scrutiny. According to a recent survey conducted by JP many industry executives believe that almost 70% of today's Australia super funds will completely disappear by 2025. Regulatory risk is not new to the industry, let's face it. The real challenge for funds is represented by the quantum and speed of regulatory change. Fund executives believe that meeting new regulations is the biggest challenge over the next 3 years. The argument in favor of greater consolidation is simple. Bring smaller funds together and reap the benefits of economies of scale, from back office to investment activities. Everybody wins, or so it would seem. But do we really know the consequences of consolidation? Is bigger always better? And is there a risk of growing too fast, too soon? These are some of the important issues we hope to address with our panelists today. With these fundamental questions in mind, we would like to start off with a quick poll to gauge the audience's initial view on whether the current trend in fund consolidation is a good thing and should continue, or whether it's a bad thing and potentially harmful to consumers. We will let you know the results of this poll during the Q&A session later on. So I would like to start off with David Bardsley. David, thank you for joining us today. KPMG has produced some excellent reports on superannuation merger transactions. I'm thinking of your annual Super Insights and the interactive KPMG dashboard. How many mega funds do you expect to see over the next, say, 3 to 5 years? And do you expect these mergers to be among big funds, or rather a bus-stop model where mid-funds accumulate assets across sequential deals to build up scale? Can you give us a bit of a sense of what's happening to the structure of the industry, please?
I can, Lorenzo, and thank you for the opportunity to be with you, your colleagues and the other guests today. You're quite right. The rate of consolidation that we're seeing in the Australian superannuation landscape is really second to none that we've experienced before. I look back to 2011 and the 5 or 6 years through to 2016, and there were really 13 mergers that were material in size that had been announced and subsequently run to ground. If we look then at a slightly shorter period of time, 2017 to 2019, in that 36-month period, there were 17 material mergers announced. And when we consider just the last 18 months, we've seen 16 mergers announced, and I'm aware of another 3 or 4 that are certainly very close to being announced. So that rate of consolidation that we're seeing in the sector is really unprecedented. The question specifically, how many mega or material funds will there be in the sector in the next 3 or 4 years? I'd have to say that we would see a concentration of 13 or 14 large material funds. They are funds with more than $70 billion in assets under management. But for me, I think, Lorenzo, the next horizon, and that is as we see consolidation occur, and whether JP Morgan is correct in their analysis or not, whether it's 70% of sector consolidation or 50%, it is going to be material, and there are going to be substantively fewer participants in the sector. But when KPMG uses its Super Insights analysis and some additional modelling overlay on top of that, we actually look forward to 2040, where there's 3 what we would characterise as mega funds with FUM greater than 500 billion. And there's probably another 10 funds that exist today and are going through a rate of organic and inorganic growth that will, by 2040, have over $250 billion of FUM under management. I think the audience or the landscape today, where there's a handful of funds with more than 200 billion, fast forward another 15 or 18 years, we're going to have a material number of sector participants, unlike banking and insurance, other financial services sectors where there really is 3 or 4 key participants. I can see an environment where there's still 15 or 16 materially and globally relevant participants.
I see. David, I would like to stay with you. And so if a fund is looking to consolidate, what should key reflections be for say, fund executives when trying to identify potential merger partners, for instance? I mean, what do they look for before saying, okay, this is I know that APRA has a sort of a list they should keep for consideration, but what do you see or what do you think should be these key reflections for, let's say, an acquiring fund or a potential merger partner?
Lorenzo, when KPMG works with trustees or senior executives within a fund, it starts with strategic intent and the direction that that fund has formed a view around as being relevant and important for their members and their sustainability in the market. There are key attributes that we feel funds should consider, size, rate of growth, investment philosophy, operational complexity. So there's certainly a range of attributes that we work with funds in determining what's important for them. And once we understand the attributes that are important to them and the alignment of those attributes to a strategic intent, we can help them look at the market and identify whether it's 5, 12 or 15 funds that exhibit traits and characteristics that meet or satisfy strategic intent and an operational outcome that in fact is going to be achievable. Not all merger partners are equal, Lorenzo. If you bring 2 funds that are really struggling operationally together, you don't just create a scale opportunity around benefit, you create an operational complexity that needs to be worked through. So one of the things that we say to funds when they're considering a merger partner is the risk, cost and effort associated with the transaction going to net deliver financial outcomes for members and operational efficiency that is sustainable, not just a long-term issue of legacy complexity in operations.
I see. And also, how do you see these funds after the merger, say? There are also some cases of mergers between a retail fund and an industry fund. How do they manage the diversity of the product members, which I think is a very important issue here as well?
I think it's a complicated consideration that's far more relevant today than it was even 18 or 24 months ago. I think the promise of scale and the promise of funds coming together to deliver improved efficiency operationally, better product, the ability to invest more efficiently in new services and cost productivity benefits. There are many cases where the promise of the merger hasn't yet been realised. And I do think that the regulator is starting to look at, there was a commitment made in bringing the funds together. How is that now manifesting in real terms across the investment portfolio, fund operations, and the product offer and services that are being delivered.
Thank you very much, David. I'd like to move to Mark, because obviously we are really looking at trustees and governance more generally here. The regulatory pressure is definitely on for the directors of superannuation fund trustees to find a merger partner. Trustees and directors who fail to ensure the legal governance, compliance, due diligence risks are appropriately addressed are placing themselves at significant risk of a claim being made against them. I would like to hear your view on the current challenges faced by directors and what is your experience at HESTA?
Thanks very much, Lorenzo, and congratulations on this seminar. It's great to have the university sector working on this practical issue. My comments are not HESTA related, just to be absolutely clear. And for people who don't know me, I used to run global asset management companies as well. And to some extent, there are sort of crossovers here as our funds grow. The industry, as everyone would know, is at an incredibly intense moment of regulatory kind of change and regulatory oversight to some extent. Your Future, Your Super, for example, is a significant change in the way assets are being reviewed, the way they're being looked at. And I'm certainly a fan of the industry being assessed, but it creates extra complexity. Then, of course, as you mentioned, it's the issue of mergers. I think the issue of mergers is important because what we're doing is we're doubling and tripling sizes of funds. We're making quantum leaps through tipping points. And tipping points occur in asset management or in any business, and if done badly, can have long-term cultural impacts. I think there's not a lot of people, for example, that have done mergers, and one of the keys for mergers, for example, is how you blend cultures. And if you do not get that right early, you get into trouble. But on a basic question, for example, there's analysis around the size of teams. When I ran the Future Fund, we talked a lot about this, at about 150 for a size of a team. Through that, you have to rethink your culture, the way you work the team. And then, of course, if you get very large, you start to work offshore in different regions. So there's a lot of tipping points that are occurring, not just to come up with the merger, but in the post-merger phase. And I think this is going to be an interesting challenge. I'm not thinking of a specific example, but if you doubled or tripled the size of the business, it may well be you need to change the management of your fund to bring in people with expertise, with broader, running a larger size pool of assets. Now, all of that said, I observe the industry doing a very good job here. I think the regulators are doing a very good job. I think people are thoughtful about it. But there's some of the broad issues that funds need to think through. Merging is terrific, but we're really here for the members. We're here to run the money. And when you get to large scale, it is almost like a completely different business with lots of benefits, but you need to think with a fresh sheet of paper as to how you run a larger scale business. If you don't get that right, large funds can get themselves into quite a lot of trouble. As I say, cultural issues, complexity is more difficult to manage. So these are the sort of transitions that I think are challenging for trustees. The merger is a great idea, but the skilled approach to the way a good merger works is almost like a completely different skill set. And I think funds need to get their minds around that as they go through this phase.
Thanks, Mark. I would like to stay with you, but I would like to move the focus to the implication of consolidation for performance, of course, the big elephant in the room. Proponents of greater consolidation argue that larger funds may benefit from economies of scale. They could generate better performance from increased ability to invest in a wider range of performing assets, such as unlisted equity, infrastructure, alternative investments. Of course, there are also arguments against consolidation, typically cross-border between industry and academia, that cite empirical findings that very large funds might find it difficult to deploy their huge amount of capital in an active way, which seems to be the biggest contributor to net returns. First, second, obviously the biggest contributor to returns is the internalization of the team and the assets. So since it all comes down to net performance, could fund consolidation, in your view, eventually hamper long-term member outcomes, or do you expect larger funds to have better capacity to invest, say, in a wider range of performing illiquid assets? Well, what's your view? I mean, this is obviously a big topic. I'm sure a lot of the attendees are very interested to hear your view with this.
I've already alluded to this. A badly managed merger could result in poor performance. I think that's a real possibility. But just to sort of, in a more constructive way, I think the key for trustees and the key for executive is to say my comparative advantages at, let's say, 60 billion were X, my comparative advantages at 200 are Y, and really treat them completely separately. Also be realistic about it. I did hear a CIO at a very successful large fund, without naming them, he made a really critical point, which is that even though 200 billion or 250 billion is big by Australian standards, when you go offshore, you're actually not that big. It is very big, but for example, if you assume that you can get access to the very best private equity talent or the very best unlisted talent in markets, it is a different and hot environment out there, let alone the challenges of once you've got good stuff, if you're going to sort of build those teams around the world, retaining them and operating in a more competitive environment. And so there's lots of transitional issues there, but if done well, I think there are comparative advantages. You can get scale, you can get teams in lots of different asset classes, lots of internal skill sets. The flip side is you get large teams, you must have good, strong culture, have really experienced people who know how to run teams who are scattered in, for example, different locations. So I think it's about thinking completely differently once you're doing the merger, that the best practice approach to running a larger fund is different to what you used to do, and just having a completely clear mindset in the way you set up and develop your teams. We're also likely to see, for example, more offshore investing as funds get larger. That's pretty clear. I often say to people who don't sort of watch this closely, you know, I think Aussie Super or something would be equivalent to a $2.5 trillion fund in America. That gets your focus of attention when you compare it to the Australian marketplace size. But funds like Australian Super, I think, are already thinking that through very carefully. But we're likely to be more offshore investment orientated. What skill sets do you have on your investment committee? And all of those sort of issues are absolutely critical if you're going to extract value. But there's a long lesson in any mergers in any industry. If it's done badly, it can detract. And the example that I sort of give is that complexity can build, and some of those things, it's like barnacles on a boat, it starts to slow the speed of the operation, it affects the way you invest, and it's at the margins that really adds value for investors. And so teams have to be very clear-sighted and really take a different mindset once they've decided to merge. And I think that mental break between the two environments is absolutely crucial.
Thanks, Mark. I would like to stay a bit longer on this topic of performance and bring in David Carruthers. David, thanks for joining us today. One of the stated aims of the controversial Your Future, Your Super legislation and performance test is to drive fund consolidation based on the assumption that larger funds are in a stronger position to provide better member outcomes. So I'm really curious to hear if you found any sort of evidence on the relationship between, say, asset size and the performance test outcomes, for instance. Here at UTS, just to give you an idea, we've looked closely at the mergers, of fund mergers, and I'll probably bring in also David Bardsley to hear whether KPMG has any evidence on that. We couldn't find any statistical significant reduction in fees, to be honest, or any improvement in net performance, but it might be that because it's a focus on mergers, maybe it still requires a bit of time for both the reduction in fees and performance to mature or to become more evident. So what are your findings? What is your view on this issue?
Yeah, thanks, Lorenzo. A number of questions to pick up there. And just picking up quickly on what Mark says, I really endorse what he says in terms of if you're going to move to be a bigger fund, then don't do things the same way, because what's the point, right? If you're going to be bigger, you need to start to think differently and act differently. And also, we think there's some benefits of being bigger, but there's also some disadvantages. You know, there are economies of scale, and we're seeing that with funds already, that they really are too big to invest in, you know, small cap Aussie shares, for instance, because they can't make meaningful positions within that. In terms of the test, you know, we've been quite vocal about the Your Future, Your Super test. We think it's right and good that funds are kept to account. it's the right thing. You know, they are government mandated that at the minute 10% of contributions go into there, and they need to prove that they are doing a good job by members. So no problem with having a test in place. Our issue is the test that we have the right test, or is the consequences of introducing the test introducing things that may not be beneficial to members in the short term? So we've got to remember that superannuation is a long-term investment. You know, we've got a test that's 7 or 8 years. It's been really interesting in the market recently. So we had a number of funds that failed. I think there was 13 funds that failed as at 30 June last year. The market's changed. You know, we've seen equities go backwards over the last 3 to 6 months. And we think a number of the positions that funds were in will have changed significantly over that period. So were those funds that failed 30 June last year bad funds, or were they funds that were just positioned for a downturn that hadn't quite happened, but it is now happening, and are therefore marked poorly on the test, reasonably short-term test, just because markets were in phases, right? So we've got to be really careful that what we want ultimately is members to be in funds which are strongly performing in the future. And we're very, very definitely, and you know, you come from a research background, we can pull up lots of research to say, and our regulator ASIC has said past performance is not necessarily a guide to the future. Every super fund out there will have that every time they mention performance, but we have a performance test which is solely based on past performance. So we just need to be careful with that.
You know, I do understand the obviously the rationale behind the introduction of the performance test. As you said, there are a lot of very strong merits behind the tests, particularly if you have in mind greater transparency of fees, possibly pushing toward consolidation, and having a larger scale, the possibility and opportunity to invest in, say, infrastructure assets. So assets that maybe a small funds would have more difficulty to hold in a large percentage in its portfolio. And I do share with you the view that, you know, there might be some issues with the way these performance tests control for risk. I mean, many people say that the performance test has risk controls, because you are inevitably looking at the strategic asset allocation of the fund. And so that could be a sort of a risk control. But there are a few, I mean, from an academic perspective and research-wide perspective, that is not really a risk control. And so, and plus there might be some issues that are related to the benchmark error. So, but that could probably be the topic of a different sort of panel event. David, just staying with you, I have a follow-up question on something that has been mentioned previously by Mark, and you picked up on this, the asset internalization, right? So there has been an increasing number of large funds that have accelerated the pace of in-house management or an asset internalization more generally. And thinking of, for instance, CBAS, you know, Australian Super, while other funds and others have made the decision, at least in the short term, would say, to rely on external assets. Now, a few studies have looked at the performance benefits of internalization among large funds. And of course, the results might not apply necessarily to all funds. And that's probably the reason why some of these super funds have made the decision to stay with external providers. Do you expect this consolidation to sort of boost the share of in-house managed assets? And if so, what assets do you think are the more likely candidate for in-house management? People talk always about fixed income first, equity second, and then all the others later. So what's your view on both the relationship or the effect of consolidation on the in-house management and then also candidates of in-house management?
Yeah, definitely. It's a trend that we've seen over the last few years, and it's something that we're expecting to continue. So as funds get bigger, they can start to take things internal. Is it just a cost benefit? So are they just reducing costs? and that's important. Are they actually producing better outcomes for members? That's the ultimate test. So it shouldn't just be about costs, and that's the hard thing, right? It's really easy to measure the cost outcome. So, and same for a merger, right? Two funds merge together, their costs come down in terms of certainly administration fees, but really the ultimate test is, are members better off in terms of investment returns, performance, better services? How do you measure the actual benefits of all of these things? I think that's the key. And some of these things, the jury's really out. Bigger is not necessarily better in all circumstances. We think there's a place for small funds that can be nimble, can do things, implement things quicker, and in meaningful positions to take advantage of that. But certainly across what asset classes do we think? You know, there's some easy ones where people kind of say cash is kind of a straightforward one, fixed income, maybe equities is the way people are going. It's more the interesting one where funds start to internalize kind of their unlisted assets. That's a pretty specialist skill. So we think those are the things. There's probably some really big benefits of doing that, but it's also a harder thing that we'll see come later in the cycle.
Yes, and also I guess the question is then also what kind of, whether this consolidation could change the incentives and disincentives to say invest in assets that might not be consistent with probably your future, your super performance benchmark. So how do you then find the right balance between these two forces, right? The consolidation on the one hand, and then the legislation on performance benchmarking on the other end. So but we'll come back to this later on, because I could see in the chat that we have quite a few questions on this point. So maybe Chris, later we can highlight some of these issues. Jack, thank you for your patience. I have a few, I think, probably overarching questions for you. One of the strongest argument for consolidation is that larger scale will drive down average cost per member. So the logic is obviously intuitive and the underlying reasoning sounds quite compelling. However, this is based really on the assumption that competitive industry forces will translate these per unit costs into lower fees. Now, given that there are high barriers to entry from restrictive regulatory policy, there is a diversity of products and member services, and there is a low fee sensitivity of members despite the greater transparency there, and quite a few other aspects that seem to be really aligning with weakening competition. Could we end up in a situation where industry concentration, and I'm making the assumption that we won't have strong international funds coming in the Australian market, of course, okay? Because that's an important aspect. But could we end up in a situation where industry concentration around few providers could become a hindrance to competition and the sector's long tradition of both innovation and quality service to members? What do you think? What's your perspective, Jack?
Let me start with something related. I've never agreed with anything Peter Costello has said, with one exception. When he said there should be one super fund, he mentioned a future fund, which is obviously the wrong thing to do, but I believe there should be one super fund, single one, end of story. And if necessary, I'll get back to that. So that's the end result. But let's assume that's not going to happen, and the forces against it, which are not pure forces, usually agency forces. Let me start at the beginning about scale. If you look at the literature on scale, and it's usually about companies like widget manufacturers, where scale is an obvious advantage, the standard model says that if you plot average unit cost against unit output, you get a nice curve that goes down, and at a certain, there's a minimum, and that minimum is where marginal revenue equals marginal cost, and that's an equilibrium position, and that's where you should be, because anything more than that, bigger than that, and you get diseconomies of scale. Now that model has all sorts of problems when you apply it to super. First of all, it assumes there are no variable costs, that all costs are fixed costs, and secondly, it assumes there are no frictions like regulators. But worse than that, what is the output of a super fund? It's not a number of widgets. And most people talk about returns. I don't see that as the output, because returns are beyond our control and beyond our influence. The output is a risk-adjusted, risk-managed portfolio. Here's the portfolio we think is going to be best for you. What the actual returns do, that's beyond us, of course. So, but even with that, so that makes the whole issue very complicated about what is going to stop going to a minimum point. The evidence about whether super funds and pension funds and investment managers can actually capture economies of scale is very mixed, as you said. There's Bauer in the Netherlands, there's EDHC in Paris, there's KPA in Toronto, there's KPMG here, there's UTS. They've all studied this and found the evidence is mixed for both pension funds and investment managers. So there's no clear thing there, other than, of course, with listed equity managers, size is a diseconomy, as everybody knows, but doesn't stop everyone practicing. As for mutual funds, Malkiel studied funds from 1960 to 1990. He found the funds under management increased by a factor of 95, and the expense ratio, big surprise, also increased by 40%. So really a very poor example. Thomas Philippon at NYU has studied this for mutual funds going back from 1880 to 2015. And he found even when he had quality adjusted things, that he found the costs of running a mutual fund were more or less constant. And that's in spite of massive technological advances, which is always offered. So it's pretty hard. And why is it hard? Well, first of all, there's organic growth is difficult, as we know, very hard, increases complexity, increases conservatism, increases number of directors, increases salaries, increases the number of people. I've been in a fund where, look, we can put on another person. It's only going to cost 1 basis point. Well, obviously they're going to add 1 basis point. Well, no, that's basis point creep, and it's regular, it's consistent probably in most industries. Of course, it increases the number of agents. All those barriers make life very hard. When you merge, the evidence on outside super, but on corporations, when companies go through M&A, the evidence again is rather against it. The evidence is some mergers and acquisitions work very well, but the large bulk fail to meet their objectives on costs and on everything else. And there are lots of obvious reasons, but some subtle reasons are you can end up with legacy systems that don't talk to each other. And that sounds easy, and it's not to get rid of. You can end up with groups of people that don't talk to each other, all of which increases inefficiencies and therefore makes getting the actual costs difficult. So, and as for competition, I've never believed that super funds are different. I think all super funds are the same, and people know that. The color of their brochures are different, but there really is no difference. You can't have a competition system that works if you have massive informational asymmetry, and therefore you can't judge quality. No one can judge the quality of a super fund. And in fact, they're all the same. But that's true in all industries. Big industries all converge to the same thing, because the risk of being different is too huge. So those things, does that mean they're not going to work? No, large funds can work. BlackRock I've dealt with BlackRock a lot. Got to say, they're very impressive. They manage $14 trillion in Aussie terms. Microsoft, Apple, all of those, they work very well. And the sovereign wealth funds don't have competition. And I think most of them are really managed and run very well. So I don't believe that competition is even advisable, because it ends up wasting money on advertising and sponsorship. And one fund would get rid of all of that.
Thanks, Jack. I think it's probably something to consider, particularly your view that product diversity is in the eye of the beholder, and the beholder is obviously the product member. David Bardsley, I have a question for you on probably this aspect of competition, but more generally, I guess, on the performance of these mergers. I mean, what is the outcome that you at KPMG have found on the this wave of mergers and the effect on performance?
Lorenzo, I think I can share some perspective on the business cases that we have been privileged to either participate in authoring or have reviewed through an assurance process. And the business case often articulates the transactional benefits, both strategic and financial, the risks, implications and complexity in bringing the funds together. And what I would say is this, that between 45 and 65% of the benefit, depending on the business case that you're looking at, is derived from investment-related efficiency. So there's certainly a focus on being able to better mandate third-party managers to deploy, manage capital or activities and services internally that either generate revenue that wasn't being generated by two smaller funds independently, but does warrant consideration and implementation as a strategy in the investment function if there's some scale. The other interesting observation around bringing the two funds together is where there is another 30% of benefit, and that is in member service delivery and administration. Too often we see a lot of inefficiency in bringing funds together operationally. I mentioned that earlier. Often that can be a net zero-sum gain in bringing funds together, because there can be a multi-year program to re-platform administration arrangements if you're internally administered. It's not to say you shouldn't do it. It's just to say that it can take some time to actually come through the hockey stick and up the other end into a net return to the fund and its members. I do think that we are going to see more concentration in the system. We were discussing that a moment ago. And I think a lot of the benefit of that concentration should be seen and sought to be seen in the investment outcomes, not necessarily the operational efficiencies. It's not to say that Jack's wrong, not right. Funds do need to be more efficient, more accountable about how they operate themselves outside of the investment function. There is lots of inefficiency as we see it in the sector, but the bulk of benefiting bringing funds together, in our experience and consideration of the business cases, is in the investment function.
I see. And so I guess probably a follow-up question on this is, if it's all about efficiency, and we know that APRA and Treasury appear to have selected size and fees as high priority areas and suggested that any fund below $30 billion is subscale. Let's assume that this minimum acceptable size is a frontier size, that is, there is some scientific validity to this number. How can small and mid funds with AUM less than, say, $30 billion or $40 billion survive in a supersized industry when there is this issue with the efficiency of their operations?
Look, I've certainly got a perspective on that, Lorenzo, that I'm happy to share, and I know that other participants on the panel will certainly have a view. The benefit of large participants in the market negotiating mandates with third parties and other service providers needs to be leveraged into the negotiations that smaller participants in the market take. The second observation would be there's an ability for smaller participants in the market to pool in certain investment circumstances to access whether it's property, infrastructure or other unlisted securities in a way that independently might not have been efficient, but as a collective of two or three, all of a sudden does become efficient. So how you access or how you create some benefit as a result of the market itself maturing and becoming more globally relevant is an important factor, and certainly something that CIOs and CEOs should be considering.
Thanks, David. I would like to circle back to the other panelists and ask Mark a critical question on the risks associated with the ongoing consolidation trend. Just a few days ago, I found I was reading the submission by the RBA to the Financial System Inquiry in 2014, and the RBA identified the increasing degree of concentration of the superannuation industry as a systemic risk to financial stability. Now, I was looking then at the data on the KPMG dashboard and some of the data from APRA, and I found that, I wasn't surprised to find that the 10 largest superannuation funds, excluding SMSF, so the self-managed super fund products, were managing, so the 10 largest superannuation funds were managing 63% of the total assets, and roughly the same percentage by members. So Mark, isn't there a risk here, and I'm quoting the RBA, that the asset allocation choices of 1 or 2 or even 5 relatively large super funds could have wider implication for the superannuation industry or the financial system more generally? What's your perspective on this?
It's a very good question. And let's just talk about the investment component of that, because there's obviously other risks such as cyber, et cetera, with very large funds and the confidence that you have behind that. But just in relation to investment related, here in Australia, I think we've been lucky in many ways in recent times because of the mandated nature of each fund and the certain flows that they've had. I do believe different styles and approaches have developed between funds. Perhaps not a huge array, but there has been slightly different approaches. There's no question that under a competitive environment, with the changes in the regulations and other factors, to me, it's creating increased peer type behaviour or the risk of peer type behaviour. It's certainly becoming a kind of a greater feature. Peer-to-peer behaviour can be, if you've got a systemic risk which is concentrated, i.e. peers are all bunched together or start to behave in a more unified way, I think you do get a more systemic risk potentially. There are regulations around it, there are issues of diversification, but the sort of thing that could occur, and this is very much a could, but things like the management of the Australian dollar, the management of cash flows, everybody's exposed to the same issues. For example, if we get a major correction in currencies, people need to cover hedging positions collectively, and a range of those issues, particularly if funds become more and more offshore, become more unlisted offshore. And certainly in my time as CEO of the Future Fund, and the Future Fund I think has thought this through a lot, my first point of concentration there was around the management of liquidity and the way you manage hedging, for example. So there are a bunch of systemic dangers and risks potentially that can develop in a concentrated portfolio of funds, particularly during moments of crisis. I don't think we've got that so much now, but it's certainly something that the Reserve Bank needs to look at. And there are a number of others that do need to be considered. This is the benefit of having a very, very sizable pool of capital. Just on the flip side is there is an offset to that, and people often don't talk about this. During the GFC, the super system, and we can pick a number, and I'm sure probably Jack's got a better number than me, but I think about 100 billion of equity was raised. Companies were supported by the system. And so you do have an offsetting potential systemic benefit of having such a large savings pool. You just have to make sure you manage the kind of negatives and keep the positives available, et cetera. And I think that's going to be critical.
Thanks, Mark. David, Carruthers, do you expect strategies or investment strategies to change as a result of this consolidation? I think that's probably another big topic being covered out there. Well, what's your view on the methods? I mean, people talk about, say, strategic asset allocation, TPA, and so on and so forth. Do you think this could change the approach to managing the portfolio as a result of a more consolidated portfolio?
Yeah, I think so. Coming back to what Mark was saying early on, is if we're seeing big funds operate the same way as small funds doing, then kind of what's the point, right? There are some small operational efficiencies there, but the big gains are kind of seeing bigger funds do things better, potentially cheaper, but certainly better. So more specialization. The hard bit with that is if we go down Jack's route and say, let's put a small amount of money in a new venture that sounds really interesting, it's got to scale. Putting 10 million or 50 million in something when you're a $200 billion fund, it's frankly not going to change the dial. So there's an element that, yes, you want to go slow and put your toe in the water, but you also want to make meaningful positions that are not just playing around the edges, look smart, doesn't really change, because at the end of the day, it's the outcome that members get, right? So that's what we've got to concentrate on. If we're not getting that, and if we're not seeing that, if we're just making something that looks bigger, more complex, and makes us feel really impressive, and we all get paid more money, but the member's not doing any better off, then we're not getting the benefits of it. So
thanks, David. I would like to bring in Dr. Chris Glover, who has been moderating the chat and Q&A. Chris, thank you very much. But before doing that, Chris, maybe if you could share with the panelists and attendees the results of the poll. I'm very curious to hear the audience's view on the issue.
Sure, yes. So I'll just share it. Maybe you can see it on your screen, but it was pretty mixed. It's pretty much a third for the no. People think that 37% think that the consolidation is clearly beneficial, and then 31 and 32% for yes, there was potentially some harms, and 32 for not sure. They're still not sure. They're still on the fence. So I think there's still lots to discuss, and I think hopefully this discussion has helped clear up some of those undecideds. So yeah, and there's lots of action going on in the chat. So lots of things.
Yes. So are there any questions on issues not covered by me and the panelists, so that we can maybe address some of those?
There was one that was specifically targeted to David Bardsley. Maybe that's one thing. Maybe hopefully in a good way.
Thanks,
So David, are you seeing emerging funds look to gain competitive advantage, add additional value to members through operating with multiple administration providers for different member cohorts? So that seems very specific to you.
It is, Chris, and I think the answer is we are seeing funds considering options around how they administer member cohorts. I think there's an opportunity for administration service providers to improve and drive efficiency into how those services are made available. We're certainly seeing the advent of a more modular administration arrangement to provide flexibility to funds in how they might differentiate the service proposition. I do accept some of the commentary earlier that you know, what funds do are at the moment very homogenous across all service providers. So the answer to the specific question is yes, there are funds looking for optionality around administration, but they will need to consider that carefully. Because we do know that there is benefit in scale administration arrangements, both on an in-sourced and outsourced basis. So it needs to be a careful consideration, and I would probably hazard you shouldn't run multiple administration systems over subscale cohorts of members for a long duration of time.
And Lorenzo, the other theme that seems to be emerging from a lot of the questions is just more. The audience seems to want to know more about the impact of, or the relationship between scale and return, and return to investors from the, so that the negatives of the scale for the return, in a sense.
Maybe David Carruthers, would you like to?
Yeah, I'm just sorry, and I think you did.
Also for you. You know, we might pursue lower fees, but end up with or experience these economies of scale in performance.
I think what we see with some mergers is the rationale and the benefit people portray is kind of like you'll get lower fees. Fees and especially administration fees has a small impact on members' outcomes. It's really around investment returns and potentially investment fees, so net investment returns, right? Specifically answering that question at the minute, there is no statistical significance in terms of bigger funds are returning. That's partly a reflection that there isn't a heap of bigger funds, you know, a dozen or so big funds, so it's hard. We see some element, but also we see some really small funds which are doing a good job as well, and not to downplay that as well. So I think, you know, there's a little bit of Kool-Aid going around about saying bigger is better. The jury is still out on that. It needs to translate into better outcomes for members, not better outcomes for funds themselves. So that's kind of the test, and we haven't seen that result distinctly yet.
There was another question about the superannuation funds are expected to own about 60% of all stocks listed on the ASX by 2033. given the large funds cannot invest profitably in certain asset classes. So what's the implication of the consolidation on more general asset prices? So this is related to your discussion on systemic risk in the super industry, but broader outside of the super industry, but for the asset markets in more general.
Mark, would you like to take that question?
Yeah, so I think I saw part of that question as well, and I think it also asked about things like small caps and what the influence are. Fortunately, the system's going to be quite broad. You know, people are retiring, they're running their own super funds in retirement. But also I think the larger funds need to think through the small cap. I'm certainly a fan of large funds being careful about creating complexity, particularly in their internal teams. But there are some advantages, for example, of a large fund having a small cap portfolio or a team running small caps. Even though it doesn't add a lot to the total fund's performance, it may add a lot to the information flow, the understanding of markets, the understanding of the economy, and at the very top level, knowing that better and allocating, say, between Australian assets versus international is where you have a major impact on your portfolio returns. And so there are some pockets here where you'd think the large funds shouldn't perhaps do it. Maybe it's even in VC in Australia or other things, but there are some areas here where you should have them as long as it doesn't create too much complexity, because you're getting information flow that affects other things you do. One benefit of internalization is that you get information flow, you get people who are investing on a day-to-day basis, feeding up to the asset allocators and keeping them current, not making them academic. We don't want too many economists doing, we want people to actually understand markets. The flip side is that they all need to perform. And so you need to have really clearly defined performance structures, doesn't matter what your structure looks like, and make sure the whole thing interacts and everyone's just delivering. So yeah, I think it is going to potentially squeeze large caps. We've seen this with indexation, arguably, where it's carried momentum of some sectors, but the market does have a very clever way of actually resetting that eventually. And maybe we're seeing that right now where the power of flow into, say, large caps potentially gets reset as the market finds that inefficient. So I think it can reset itself from time to time, but it does have to be watched.
And I guess the final theme that seems to be coming from the questions is basically, and I'm paraphrasing the questions here, what can be learned from other countries overseas in terms of optimal industry size? How many funds? I know Jack's proposing one fund, but one of the questions was, how do we stop the one fund becoming lazy and other issues with the super fund? So what can we learn from overseas in terms of optimal size?
Well, can I answer that? For a start, large organizations, the myth about large organizations is that they're bumbling and they're safe and they're inefficient and so on. And it's probably true that most are. However, it's not necessary. Forbes magazine every year has a list of, I think, the 100 largest, most innovative companies in the world. And you would be surprised how amazingly efficient and innovative they are. Cisco, for instance, IBM used to be in that. So there's a risk that they die. Competition there's a bit of a myth about competition that it leads to that. And you don't need that. Large organizations can do very well, even very bureaucratic ones. If you can have skunk works that do brilliantly, the Soviet space program. Now, who would have thought that the Soviet system was going to be efficient? The Soviet space program got out and into space before America did. It was an amazingly effective operation. And you see that all around the world. The big funds, certainly APG at 250, 300 billion, has got a huge amount of innovation in it. And it doesn't have competition. Doesn't see, unless globally it looks a bit that way. And if competition, the aim of competition is to learn and mimic, you don't need that domestically. As long as you've got it around the world, you can. There are plenty of government departments that are innovative and they don't have competition. You know, do you need two police forces? Do you need two armies? Do you need two legal systems? Those are things that can, and in many places, work very, very effectively. And I think superannuation is a public good and therefore should be devoid of that sort of competition. Doesn't mean it won't be effective or efficient.
Mark, did you have a question? Would you like to say anything? I saw that you raised your hand.
I just disagree with Jack. I think you don't need too many, but you need a lot. There's a lot of analysis that shows, for example, people when leaving one firm to another bring innovation, they bring a new desire to grow and drive the business. I think you need a healthy mix of competition. The Canadian system has a number of funds who do things differently. They talk of each other. Jack's point is right, you can do that globally. But I did 15 years of asset management turnarounds in London, and I can assure you that when large businesses start getting lazy, they are very hard to fix. And once you get into that cycle, it can be very detrimental to the performance of the members. So it's a balance. I think Jack's general point, which is you don't want excessive numbers, because that all that does is ramp up agency, but you need a reasonable number to keep it hopping and deepen the talent pool and make sure that everybody's at their very best. And I think there's a balance there. Thanks very much.
Thank you, Mark. We are running out of time. Well, thank you very much. Obviously, the issues discussed today are very thought-provoking. As you can see, we can go on and on forever, but unfortunately, the clock is ticking here. And I'm very mindful of your time. So on behalf of the UTS Finance Department, I would like to thank our panelists, Mark Burgess, David Bardsley, David Carruthers, and Jack Gray, for sharing their view and experience on the issues discussed today. Before letting you go, though, I would like to mention that the UTS Finance Department, we have a team of specialists monitoring the impact of performance tests and the effect of the consolidation. So if you would like to reach out to us, please contact me via LinkedIn or the email listed behind me. Also, please feel free to follow us on LinkedIn for information about future free and exciting events organized by the department. Thank you all for attending our event today. Have a good evening, whatever your time zone, and see you soon. Thank you.
Thanks.